Risk is actually, or having the risks openly, it's actually a way to sell an investment opportunity. The best time to negotiate is when you don't need capital, and that's when you start. You can raise debt, even though the debt might be expensive, it is mostly cheaper than equity.
What are the top three signals you look for in the first 10 minutes of reviewing a medtech company? Okay.
Compared.
Welcome back to another episode of the GS MedTech Podcast, where I speak with industry leaders shaping the future of medtech. I'm Dame Medarsky, and today we're exploring crowdfunding. Often misunderstood, some founders think it's easy money, others see it as a last resort. And even among VCs, some view it positively, while others remain skeptical. In this episode, we'll break down when crowdfunding actually makes sense for medtech, how regulatory and clinical risks are assessed, the difference between raising equity versus secure debt, and what founders must have in place before launching a campaign. My guest is Niklas Green, head of Investor Nordics. Niklas, thank you for joining me today.
Thank you very much for having me today.
Awesome. So maybe for listeners meeting you for the first time, what do you do at Investor Nordics, and what does your actual day look like?
I think my day is just really dependent on the day, right? So there's no typical day. What I do is I lead Investor in the Nordics. I've been with the firm for 5 years now. I've been rebuilding the company, started out as an investment manager, and then now moved into commercial director and head of Investor Nordics, really focusing on building up Investor in the region, focus also in shifting our scope on what we do more into the secured debt, more selective on the equity end. I think that's in a broad sense my day to day. What does it mean? Talking to founders, analyzing companies, talking to partners, attending industry events, reading about the economy, just having a broad perspective of what the companies need, what's offered, like really from day to day, like being an entrepreneur, basically.
Yeah, amazing. And when founders hear the word crowdfunding, what do they misunderstood most?
I think most, not only founders, but I think most people misunderstand crowdfunding in the sense where crowdfunding is coming from. So if you think where crowdfunding is coming from, it popped up late, or let's say early 2010, right after the financial crisis, to be a sort of alternative method of financing. It was a new thing, so it was really innovative. People wanted to, or some people wanted to try it out, so it sort of became something of, let's try it out for fun. And I think this is what a lot of people still view it as of today, that, it's something you do as an investor, a bit for fun, as a company, a bit also for, let's see if we can tap into the market and get visibility only. And I think that's, 15 years due already. The industry has changed so much into really you do crowdfunding as any capital raise, and a lot of players in the field have actually dropped the crowd, so it's just called funding. Even though we all operate in the same way, so we tap into individual investors who invest in the companies. And I think that's where we come to the second thing that a lot of, especially founders, misunderstand. A lot of founders, I think, believe that you are looking at small sums from each investor, because that's also how it started back in the day. That is not how it is anymore. So, you always have these people who do a small sum, but we also have really large investors in let's call it crowdfunding.
Yeah. And what's your usual elevator pitch? Who is Invesdor?
I think Invesdor is a fundraising platform. My elevator pitch is slightly depending on, am I pitching equity, so growth equity or corporate debt? If I'm pitching growth equity, I see ourselves as a deal-by-deal investor. So the main difference to a VC is that we don't have a fund, which also means that the investors who are in the companies, they choose on a deal-by-deal basis where they want to be. On the corporate debt side, we are an alternative fundraiser as a complementary to a bank.
Amazing. And obviously, on the back of that, you've directly helped transform Invesdor from retail crowdfunding into alternative capital provider. And you've mentioned, obviously, the equity versus secure debt as well. What were the most meaningful upgrades on the road from this development?
I think we start with the equity part, because equity was something we already did when I came to Investor. Corporate debt is something I launched later. So let's start at the equity part. I think it comes down to two things. One is really narrowing down what we do and what we do not do. I think that's it. So being really strict on the companies that we fundraise for. So out of the companies you see on the platform, there's been 10 times more that came to us that we didn't accept, because we didn't see either we didn't see the business model, or we didn't see the ability to raise for it. I think that's also something where we need to be honest to ourselves. Do we believe the company can make it or not? And do we believe that it's easy enough to pitch to individual investors so they understand it? That's definitely been one. And I think the second one has been really to be really, really open and almost, pushing it to investors that please diversify. You do need to diversify.
Mm-hmm.
Startups are high return potential, high risk assets, which is something you need to understand. It is just how it is, right? And that's also something where we need to be really open. We need to tell it every single time that, we are looking for good companies. We are pitching you good companies. With that said, this is a risky asset. And I think these two things have really been important for us, because one, we have increased deal quality, because we have left out the ones where we either don't really see it or we don't see the ability to raise for it. And if we don't really see the ability to raise for it, also means that, it's not really good for the company, obviously, either. And the second thing has definitely been the pushing the diversification, because what we have seen is that we have had some, happens to everyone, right? We have had some really promising companies that in the end didn't make it. Which is not a problem if you have a diversified portfolio. It is a problem if you didn't understand that you need to have a diversified portfolio.
Amazing. And if we get a little bit more practical, what is the ideal profile of a company that succeeds on your platform?
Again, if we go equity first, it definitely is a company that is easy to understand. And when I say easy to understand, I don't mean that you know exactly how you do what you do. It needs to be easy to understand, but the problem and the potential of the solution needs to be easy to understand. These are the number one things. Then how you do it exactly is not, that important that it's super easy to understand, but, day-to-day investors need to see it fast, because that's also sort of the window to the investors, right, that we have. They see the investment opportunity right there and then. They need to understand the broad level of what the company is doing, what they're fixing, because if they don't, they rarely read more. And if they don't read more, it doesn't really help what's said in the rest of the material. That's definitely one. And then we obviously have the other ones. You asked earlier about crowdfunding and what founders misunderstand. I think another one is that has also really changed is obviously valuations matter. This is something I keep telling entrepreneurs as well. The most expensive round to raise is the one that you cannot succeed with, right? So you need to have a fair valuation. Investors understand this. Investors, they have sort of endless opportunities. So I think definitely easy to understand and right valuation. I think these are the number one factors for the equity part. For the debt part, really, investors are just looking for risk and return and ability to repay.
Yeah, and it definitely makes sense, to be honest, to be an easy to understand pitch, because the investors that you're capturing, I'm assuming they're not necessarily specialists in the field, and obviously you're offering very varied opportunities to invest. So being able to grasp the information and understand whether you're interested to get involved in that is very important to attract the individual investor that's not necessarily a typical industry educated investor.
I would have to say yes and no. Now talking about medical companies, we do have a lot of medical doctors in our investor base. So in that sense, those investors actually can be highly educated on the field. They can really understand what they are investing in. But then we also have just the financial investors who sort of, are not experts in the field, but again, go for I think this is the majority for sure, that go for, okay, do I see the problem? Do I see the solution? Do I think this company can make it in this field? And is the price one that I'm willing to pay? So in that regard, absolutely needs to be easy to understand.
And speaking about medtech companies, and obviously, as I've mentioned at the beginning, majority of my network and people that will be watching this will be medtech focused, either operators or investors. What are the top 3 signals you look for in the first 10 minutes of reviewing a medtech company?
Potential return and exit. Okay. Compared to the entry value. I think that's definitely, especially thinking medtech, there's obviously a ton of variety in the field, but 100% the potential return at the exit, and obviously the potential time to exit, for sure. Especially in this field, it's way more typical, obviously, to have pre-revenue companies who are developing over potentially the next 5, 10, 15 years. So you sort of need to understand also, okay, what could a potential exit be like? And then obviously, when could a potential exit be? So what would be the, let's say, best case scenario for an exit, and obviously the worst case scenario for an exit. Yeah. Definitely these. Second thing would obviously be funding need until you get to a milestone where an exit would realistically be possible.
Yeah,
that's for sure one. And third one is the team, because the team is the one and then they are executing on it. And when you say team, it's obviously, okay, what have they done before, but also what have they done in the company? How have they been treating the company? And especially if you talk pre-revenue companies, how have they been treating company funds? So how efficient have they been in growing the company with limited funds? And there you really start seeing, team expertise in developing with a limited budget.
It's incredible. And I'm assuming you're speaking, as you rightly pointed out, with many founders, and obviously some of them understand very well equity crowdfunding. Others potentially have only dealt with VCs previously. How do you explain equity crowdfunding to a founder who only understands VC? What are the key differences founders need to understand in terms of control, governance, cap table?
I think the first one obviously is control. So first of all, we work both with VCs and without VCs. So I think that's, we definitely have some companies that have VCs in, and then we come on top. We also have some who don't have VCs in. And then we're not the sole investor, but we are the majority of the new investors. So that's slightly depending on, how the answer looks. But if we go for the ones without a VC, well, first of all, we bring essentially quiet money, if you will. The investors we have, they do have voting rights. However, they do have some restriction to those. Restrictions meaning, exits, future funding, where you do need to vote with the majority of the company. So that's a big, big difference to VC. And another one is obviously that we are not requiring a board seat. So you keep the full ownership in that sense of how you want to progress on the company. In terms of governance as well, right? It lays with the company, but this is one thing I think that is really, really important to understand is that while you don't have a VC who is, overseeing and potentially giving you a lot of help in governing the company and building the company, you need to take control of this yourself, and it's super, super important with crowdfunding because you're gonna be dealing with a couple hundred or maybe up to even 1,000 individual investors, and you need to keep them happy. You need to keep them posted, and you need to be open and you need to be realistic with them. Because sooner or later, there will be a time when you do want to raise more capital and you do want to tap back into the same investor base and build on top of it. And if you have not been treating the investors well, if they, you have not been actively communicating with them between the funding rounds, raising additional funding from these investors is really, really difficult.
Yeah.
However, if you have been communicating with them openly, they know how the company is doing, they know the progress you have been doing, even though you are not, exactly where you thought you would be, we've seen that raising the capital is way easier because the investors feel involved in know sort of what the company is doing. They feel well treated. That's definitely important. And then in terms of cap table, by default, we have, and this slightly depends on the country where we operate, because in Finland it's slightly different from Central Europe. By default in Finland, we have been taking them in as direct shareholders.
Mm-hmm.
Limited by the minority shareholders agreement. It is, however, possible to pool these investors in an SPV after the funding round.
Yeah.
In Central Europe, we pool the investors directly into a Dutch stock, which is a type of SPV. In that regard, we have two legs. Regardless of handling this investor base is a question we get quite frequently. It is not really a big hassle. Just make sure that you can have the AGM remotely. Just make sure to send updates to the investors. That's about it. It is not, in that sense, a big thing. Sometimes, you have founders asking, well, what if I need VC money later? Is it going to be a problem? That is also one reason why we have a clause that you can pool it into SPVs. So in that sense, we have seen a lot of these. We have also seen companies who didn't have the clause. It really hasn't been the problem that you cannot get the funding. If the company is really good, if you're really the one, where the VCs want to be or another professional investor want to be, that's not the problem you're having.
Yeah, you're mentioning the VCs and obviously the complications that they view, and obviously my introduction to the podcast was of the different views of some VCs in terms of crowdfunding campaign and previous crowdfunding campaign or crowdfunded businesses. What do VCs get wrong about crowdfunded companies in your experience?
They say that this is changing. This has been changing a lot, probably also because crowdfunding has been changing. We see a lot of that the VCs are more and more working with us. So I think that's been definitely one. I think it's also slightly the same things as the founders, that it's difficult to manage the investor base. It's, you have a lot of investors then voting against you. You have a lot of investors at AGMs and so forth. I think that's really not the case, right? The investors that we have, they want to have a financial return. That is the number one thing they want to have. And that's also the number one thing we want to have for our investors. We want to have equal and fair conditions for investors. We want to have investors who can invest, if there's a VC, alongside the VC, same financial conditions. That's it. If the VC wants to take an active approach and govern the company and so forth, super good for us. So I think this is really or those, let's say those VCs who get it wrong, what they get wrong is that it's somehow complex, it's somehow difficult. It is really not. And I think here we've done a lot of work over the past years. If you would go through the funding rounds we have done, most of them have VCs involved these days. Yeah. And that's in all countries we operate.
And it just makes sense, doesn't it? Because of how difficult it has become over the last several years to raise money. And in particular in MedTech, some of the VCs are having portfolio companies that are struggling to raise additional funds as well. And having this opportunity to say, well, why not try crowdfunding to supplement the investment that we're making to make sure that actually the company progresses further is just logical.
No, 100%. I think what you see a lot in the VC field, right, is syndicating. Syndicating is growing all the time. Especially in the medtech field, especially here in the Nordics, syndicating is really increasing. And, in that regard, and also outside the medtech field, and in that regard, crowdfunding is really a way to syndicate. We can sort of be one piece in the syndication, which really essentially what it does, it allows the company to have more funds. It allows the VC to invest more funds into the company, steer the company in the right direction with the help of the founders, make the same return essentially that they would, or even better, without us. And our investors are there to just get a piece of the cake with the return.
Yeah. And you've mentioned communicating with investors and keeping them up to date with the view that obviously there might be a second round where you ask for additional funds as well. Do you find sometimes, and I know from conversations with companies that you've helped raise money, like Askel Healthcare, they do a very good communication with investors regularly to keep them up to date. But also what I'm curious to know is, do you, from your experience, find sometimes that some investors actually are experts in the field, and even though they are an individual investor, they communicate with the company and they try to add a little bit more value than just the money.
None that I know of, to be honest.
Okay.
I think there might be some. There might be, there might be some. Maybe I just don't know about them.
Yeah.
But I'm sure it does happen. Not to be honest, not that I know of. I think, but for the company, let's say like this: we have investors definitely who do reach out to companies, who ask them questions, and maybe there's then communication who is going outside us. So in that regard, also, just communicating with the investor base. It's so important. And then if you do get questions, be open, answer them. And I think even more of the time, if the company is doing good, they're properly moving forward, they're properly working, communicating with investors, we don't get a lot of questions. It's more the lack of communication that's raising questions.
Yeah, that definitely makes sense. And before we wrap this up and we move on to diversification of your product portfolio, you've mentioned obviously Nordics, but I know that you're present in specific countries in Europe. So maybe that's beneficial for listeners to know about.
Yeah, 100%. So I'm based in the Nordics, meaning that we are looking at Finland, Sweden, Norway, slightly Denmark. Right now, to be honest, I'm looking mainly at Finland for the very reason that there's so much opportunity in this country. So we do still have deal flow from other Nordic countries, but it's just focus for time being for me is Finland. Might change a year from now. Yeah. In addition to that, because we are a company today, we're a result of 4 companies merging together, right? So we do have active operations in Austria, in Germany, and in the Netherlands. And we have had some really good companies in all of these, some really good medtech. So those are the core countries we're looking at, and then some surrounding areas as well.
Thank you. And you've mentioned several times in our conversation so far, depending whether it's equity or secured debt. And obviously, maybe this is a good gateway to understand a little bit more. Why does that matter for founders? And whenever they're making a decision, equity or debt, how do you cover both?
Yeah, I think the number one question, of course, you need to answer or understand. If you're taking debt, you need to repay debt. If you're taking equity, you don't need to repay equity.
Yeah.
So for a founder, the risk is really different, right? But also on the flip side of it, equity is always, not almost. It's always or almost always, it is more expensive than debt, which means that if you can raise debt, even though the debt might be expensive, it is mostly cheaper than equity. So that really comes into the fact that as long as you can raise debt, you can service the debt. It is probably better than raising equity. But when can you service debt? When you have cash flow, when you have a positive EBITDA, that's when you can do it. Up until then, you mostly need to rely on equity. There are obviously some governmental or closely related institutions who give you debt with long debt with very flexible terms. Definitely do explore this. That's also where I say almost always explore these. So I think that's those are the two sort of tracks to go. Number one, if you can raise debt, you can repay the debt. I would go for debt. If you cannot, then you would need to rely on equity. And obviously, you can reach out to us and ask the question, but it's sort of self-explanatory in a way. I think, which direction should you even look? If you don't have revenue, then it's equity. If you do have revenue, you do have cash flow, you are profitable or very close to being profitable, and you still want to scale, debt is probably the way to go.
Awesome. So translating that into a medtech business, pre-regulatory process that will be equity funded. Once you start early commercialization, you would want to actually start considering that as an option.
Yeah, 100%. I think when talking medtech, pre-regulatory, most that would be equity for sure, right? But then you also have, we see a lot of medical device companies, who are still depends on how you regard medtech, but they're still medical companies, and that's where we then go into the corporate debt side. But if we're really looking at invasive medtech, that's a good for sure.
And what does secured mean in reality? What kind of security can a medtech startup actually provide?
Well, I guess it really depends on well, if we say medtech startup, I think that's right, but we need to distinguish a bit, right? If you're a medtech startup, probably not a lot. If you are regarded as a medtech startup, you would most likely not be looking at the debt part, right? Because you would be, as a startup, you would be likely growing a lot. You would either be pre-revenue, or if you're in the revenue phase, you would still most likely not be profitable because you're growing by investing equity. So in that sense, I would more look towards, let's say, scale-ups in the medical field. I'm not even going to call them medtechs. I'm going to call them scale-ups in the medical field, because you have a lot of device companies as well. And I think that's also sort of the first answer to the question. Usually securities can be devices in the company. In Finland, we have something called a floating charge, where you can, against some assets in the company. In other regions, we don't, but then you're going to have a direct claim on some of the assets, something similar. Usually, we don't go for personal guarantees. We do, however, we can operate with those. If we operate with personal guarantees, we're still looking at, let's say, 5 to 10% of the total outstanding amount. Why so? Because it's a complementary guarantee. It's not the only guarantee or security we have. And also because it's painful if it happens, but it's, not the end of everything, if you will, right?
Okay. Are you at liberty to share what does a good founder-friendly secure debt look like when you provide it from Investor?
Yeah, 100%. I think the debt we do, as again said, it's secure, so it's depending on the assets you have. But let's assume the assets are not totally enough to secure the debt, so we would be looking at a personal guarantee of 5%. You're raising €1 million. 5% it is talking 50,000. So that would be fine. I think for most people to do a personal guarantee of this, we would be looking at 3 to 5 years in debt, interest rate, depending obviously on the risk, but we are looking at anywhere from 7 to 12%, I think, at Investor really. So there's a range. We could obviously go lower, but then, difficult to find investors. We don't really want to go higher, because then the risk levels start being too high. Then we're going into the venture debt, and we don't really do venture debt. Usually we have interest payments quarterly or biannually. We usually have a grace period of 6 to 12 months, and then linear repayments. So that's really the base structure of it.
As everything else, there is always risk in secure debt as well.
No, 100%.
In your opinion, what are the biggest mistakes founders make when taking secure debt?
Taking too much of it. I think that's, again, going back to what I said previously. It's not only founders, it's everyone, right?
Yeah.
Taking too much of it. So when you raise equity, you obviously dilute. So you usually don't want to take too much of it. However, there's obviously the question of how much can you build with it. When you take debt, you don't dilute, but the main difference is that now you have a claim for the first time. So if you don't repay, the company goes bankrupt. If you don't repay equity, the company does not go bankrupt. I think that's the main difference. So you need to understand what is the risk level you are carrying. What does it mean to be able to repay? And if you don't repay, investors, this is also a big difference, right? If you don't repay, investors are, and rightfully so, they are angry most of the time, and they really start claiming the assets because they want to get theirs back. So I think, do not take too much of it too early.
And maybe to close this chapter on reviewing and understanding what's the ideal potential customer viewers, understanding a little bit more about the due diligence that you undertake, and maybe combining that both equity and secure debt before you make a decision, okay, we are going to start working with you to help you crowdfunding.
Yeah. I don't know. It's a good question. I'll start with debt this time, because I think this is, it is still closely related to the equity we do. So what we start with always, we look into the financials. And if you're raising debt, what matters is the financials. What are the financials you have? How do they look for your forecast? Is this a bankable or semi-bankable company. What I mean is if you're bankable, you would probably be with the bank, not with us. But if you're slightly too early for the bank, it's good for us. So can you repay? What assets do you have? So forth. That's basically the structure of it. Then, if it's corporate debt, we obviously we look at what the company is doing, so forth. That's about it. If you're looking at the equity again, we look at the financials, but we look from a different angle because we are not looking at can you repay the equity, because that's not what you do with equity, right? But what we are looking at is more of how much have you raised previously, how much do you own of the company, what have you been able to conduct with the money you have raised, how efficiently are you running the operations, and where exactly is the money going, to make an understanding of what do we think you can do with the money you are raising. So how far can you get with it? And then obviously we always ask ourselves the questions here, once you reach that point, where you're going to be. Are you going to be at the stage where you need more money, or are you going to be at the stage where you reach a certain milestone so you can potentially sell the company? Or there will be a strategic investor who would be interested in stepping into it. And that's in the financial side, sort of, really fastly run through for equity. And then we have a lot of qualitative topics as well for equity that we don't really have for corporate debt, because corporate debt, you're looking at financials, can you repay or not. On equity, what you're really doing essentially, regardless of industry or company, so you are giving money to a team who you think can execute on idea in a market that you think is good enough. So, really analyze team quality. What have they done before? What have they been able to do with the company? How is the market? Do we see that they have a competitive advantage? Do we think that they can execute on it? Things like this. And that's, again, a really qualitative topic, coming a lot from, just being out in the market, seeing the market, understanding what's going on and so forth.
I appreciate that very much. Once you've selected a company to work with, you start obviously building the campaign. I'm assuming a prospectus and information that you deliver to your potential investors. What does a campaign look like operationally? What happens week by week?
Yeah, so before we let's take a couple steps back, actually. So once we see a deal, we do a quick scan of it. We have, we run through it with the company, we discuss it internally. Do we see that this could make sense? Then we write a term sheet. On the term sheet, we set sort of more lines for what the campaign could look like, valuation-wise, so forth. Usually, some frames around it that we're then working with later. And once we have done this, we really start doing the analysis, which I just described, but we also start slightly looking into the legal end. Then once we have done this, we have in our opinion, good understanding of it. We present it to an investment committee internally, where we discuss it in depth. Once we've discussed it in depth there, we might have either we proceed, or we have further questions to the companies, or we realize this is nothing for us. Assuming we do proceed, this is when we would tap in more to campaign and even more into legal. So what I just described would be, let's say, the first, like this. So the first, let's say, 1 to 2 weeks would be preliminary discussions prior to a term sheet. Then once we write a term sheet, the following 2 to 3 weeks, highly depending on how the company is delivering material. Raising capital is usually a good exercise for a company also to get their internal stuff straightened out. You really see, companies who are highly well organized to do it in 2 weeks because you get them at once. The ones who are not, it takes a bit longer. Yeah. But let's assume 3 weeks. We have a semi-organized company coming to us looking for capital. So then we are five weeks down the road, we're at the IC, and we mutually agree we think this is a good investment opportunity with a high return potential. We sign the final agreement. We start building the campaign, and we start doing the legal work. Legal work is really, again, checking that everything adds up, everything is clear, all papers in order, legal requirements you have, so forth are in order. And on the campaign side, we start building the campaign. We used to work with an investment memorandum. We don't do it anymore, to be honest. And the reason is that we saw that most investors, they don't open it. They don't really read it. The investor base we have, first of all, they trust us in the ability to screen companies. We spend a lot of time on it, so we have basically screened the companies pretty good when they hit the platform. So what we do is we build a campaign where we explain the company. We have, we also highlight risks, but really, basic what do they do, what's the business model, what's the team, what's the market, what's the traction, what's the future outlook, what's the financials, what's the risks. It's also quite visual. A lot of pictures, usually a video. People like to watch videos, like this podcast. People do like to follow stuff like that more than reading. So that would be, again, depending on the company, but let's say a week to two. We start doing it in English. There we have two work streams in these 2 weeks. So one is the campaign side, one is the legal side, really going through all the documents that everything is in order. Again, assuming everything is in order, we're done in a week or two. We also write the basic information sheet that we have under the regulatory requirements, where we also have risks, bit information about the company and so forth. And once we've done this in English, which is the default language we operate in, we translate it if desired. So now, me being in the Nordics, by default, we offer companies funding round in English and in Finnish. And then we have, add-ons that allows you to also tap into an investor market in the Netherlands and Belgium, and as another addition, the DACH region, which then would be Germany, Austria, Switzerland. And assuming that the company is going for this as well, we translate all the material, so all the campaign material, all the legal material, and so forth. All this together, I would say, we're looking at 3 weeks. So legal due diligence, campaign work, translations, we'll be looking at 3 weeks. Once that is done, we open the funding round to our investor base. I have to add that the campaign work also obviously includes the preparing the newsletters to our investor base. So the way we operate is that we have a big list of investors who we send out the investment opportunities to, who then invest on a deal-by-deal basis. So once the round is open on our platform, we send an email to all of our investors about the new investment opportunity. They are then guided to the platform. Could be mentioned here, could have been mentioned earlier, but I'm mentioning it right now because I didn't, is that all the rounds we do, we always require a lead investor. So someone else needs to be in there. Can be a VC, can be a non-VC, can be a VC who's in there already, but there needs to be someone else. I think that's one of the things also with crowdfunding. No one wants to be first. There needs to be someone in there who is leading the round. It needs to be there when we go public on the campaign. Once we are public, campaign is running for 21 days. We are again looking at corporate debt. Appetite is really high in Europe at the moment. We raise $1 million a day or something. It is absolutely crazy.
Incredible.
Yeah, it's absolutely crazy. You can raise multi-million rounds in a week. So usually there's a spike in the beginning, there's a spike at the end, there's some spikes in between when you do marketing, and the first spike in corporate debt is around about $1 million raised in a day. The market is still good, has been better, to be honest. There is more work required both from us and also from the company. So we usually do run the whole 21 days. What we do over those 21 days is obviously we send out newsletters to our investors, we do social media, also do paid ads, some Google ads and stuff like this. But we also always require and highly encourage the company to be active. So, you need to activate your own network, and whatever it means, be active on LinkedIn. You don't need to buy a massive marketing package. I think this is also going back to what the founders misunderstand about crowdfunding. Just be active. And usually the activity is something you need to start building already before the funding round. Be active on if you're a founder and a team who is active on LinkedIn and social media, it's way easier to tap into this market, because what you do need to do when you raise funding is obviously you need to be active. You need to ask your team to post, be out there in whatever way you can, because we also see that us being active and the company being active at the same time works well. If only we are active, it is usually not really working, because we are tapping into our network, but we also need the visibility of new investors, which we are doing. But a lot of the times we also see that our investors are slightly questioning it if the founders are not active. Like, are they not fully invested?
Naturally makes sense.
So that would be then let's say we run for 21 days. And then after the funding round, we have a 2-week period where we go through all investments. And I think this is highly important to do. So we screen everyone who has invested. Everyone needs to identify. We can run all anti-money laundering checks. We screen every single payment, that everything is done and complete. That takes 2 weeks roundabout, and after that we transfer the money to the company.
Amazing. On the outside of it, you look at it a very simple process, but when you dissect it that much, there is a lot of involvement from your side to support the process and to make sure that actually each and every campaign is successful as well.
No, 100%. I think there is maybe another thing that a lot of, not only founders, but let's say a lot of people get wrong. They you just find a company, just put it on the platform. That is not really how it works. Being on the platform is usually just a really small part of the whole campaign, coming from all the way of screening, understanding the company, building the campaign to ensure it's successful. Then you are on a platform, and then afterwards you need to go through everything, because you need to ensure also the companies, everything is clean after the round, which also goes into for the founders themselves. Obviously the real work starts once the money hits the account, and also the work with the investor base. So once you get the money, you also need to thank the investors, and that's when you need to start being active.
And I'm going to ask you to generalize a little bit, and obviously keeping the medtech theme in mind. Do you have particular medtech companies or teams that are consistently attracting investors' demand on your platform?
I do. I think I have one which you already named, and the podcast, who has again been doing a phenomenal work in keeping the investors up to date about the progress in the company. Mm-hmm. Hence, they've also been really successful in raising capital on the platform. That's definitely a good example. Meaning also what have they done right? First of all, they are in a field where you see the problem, you see the magnitude of the solution. Being active with investors, being really frugal with the money. So really using every single euro in the right way in the company, and then you combine all of these. That is usually a good setup for being able to raise further funding. So I think that's definitely best way to generalize it for sure.
No, I appreciate that very much. And in terms of, you talked about risk and obviously presenting the risk to the investors, but maybe in terms of an evidence, what evidence creates real conviction for crowd investors to actually get involved?
In terms of what?
In terms of attracting them to get part of this campaign, what can you present to them besides the risks that actually, apart from opportunities going forward, that enables them to be confident that this is an investment opportunity that they would like to get involved in?
Yeah, I think risk. It's good that you mention risks. Risk is actually, or having the risks openly, it's actually a way to sell an investment opportunity. If you don't have the risks there, it looks unprofessional. And I think this is also something that founders need to be very open with, because there are risks involved. There's always risk in everything you do. So you just be open about it, because you need to understand the risks that are there. Other than that, really, the way to attract investors is really, in that way, simple, easy to understand what the problem is, easy to understand what your solution is, or the magnitude of the solution, and also show the progress you have done. I think that is really what investors are looking for. The fact that you, as a founder, together with your team, you are able to build something. You are able to make progress, and obviously as much progress as possible with as little money as possible and as fast as possible.
Thank you for that. And maybe just wrapping up, if a medtech founder is listening and considering crowdfunding, whether that's debt and equity, maybe you can split it if it's required, but what are the 5 main things that they must tick before even starting?
Yeah, so 100%. I need to split it, but let's start with the equity part, because let's start with the debt part. That's the easy one. What you need to consider is how much money do you realistically need? How much can you realistically repay? When do you need it? So just reach out, we look through it, we say yes, you're bankable, you're not bankable. That's about it. If you're raising equity, I think the best, and this is not only crowdfunding, I would not split it into crowdfunding and non-crowdfunding equity. I would just say, if you're raising equity, the best time to start fundraising is when you close the funding round. Because the best time to negotiate is when you don't need capital, and that's when you start. That's also when you start, being active. Because I think being active as a founder on LinkedIn, wherever, is not only for crowdfunding. It is also for attractive VC money, or any money for that sake, right? Yeah. So I think you really start also, without understanding it potentially, you start building a funding round and a crowdfunding round way before you actually do it. And that is, by building a network, by being out there, by tapping into the market, and then you start discussing with different parties, which should include venture capital and it should include crowdfunding at once. Because if you would come to us and tell us that we've been looking at VC, but no one is investing, I'm most likely also say, yeah, I'm not going to invest either, right? So, but if you come to us and we also have some negotiations with some VCs, that's the best time to come, because then we can also give you an offer at least, okay, this is the range we can do. If you raise this from a VC, we're still interested. So yeah, I definitely think it starts way before you actually need the money.
Yeah, no, that definitely makes sense. This was very useful, Niklas. Thank you so much for sharing all of your wisdom and information. And maybe just as a last question to lead to any interested parties that maybe are listening to this and thinking, well, I would like to reach out to Invesdor and potentially explore whether that's secure debt or an equity crowdfunding. Where can funders reach out to you, and what's the best way to start the conversation?
I think the best way is to find me on LinkedIn and drop me a message that this would be interesting for us, or we're looking for funding, not only for crowdfunding, I think in general, because people in the field, and I'm not only talking investors, I'm talking everyone in the field, are usually really helpful. You ask someone, and even if they say no, they can guide you to someone. So if you're even potentially thinking about crowdfunding, and to be open, it doesn't have to be that you're looking to raise now or next year, but at some point, just drop me a message, or if you're not doing it with Investor, drop someone a message the platform you're looking to work with. That would be my straight answer.
Yeah, and to be honest, I mean, I can attest to that. Obviously, we've started many conversations, and you've been very kind to introduce me to many companies along the way whenever they haven't been suitable, maybe for the platform that you're providing, or you're not covering them, to actually instigate that conversation, to help them to progress internally what needs to be done. So first of all, I'm very grateful for that, and also very grateful for your time today. Thank you so much.
Thank you so much for having me. It's been a lot of fun.